Mike, you do say in the results commentary today that trading conditions are expected to remain difficult in 2011. There's an impact of increased utility charges, and that's something you saw coming through in 2010 as well. Take us through how the property sector is positioned for 2011 and some of the headwinds you face as we go into that year.
Thanks, Stephen, and good morning. Yes, I think that while we say that trading conditions are likely to continue to be challenging in 2011, we certainly have seen, I think, a turn during 2010 following the very tough times that we experienced in late 2008 and 2009. We've seen increased interest from retailers, both existing retailers in terms of expanding space, as well as from new entrants into the market who are looking to take space in our shopping centres, as well as a couple of international retailers that are obviously looking to take up space in the centres. So we're not expecting great shakes from the retail industry, but things are certainly looking more positive. On the utility side, I think that we are seeing ongoing challenges. We did see quite a significant increase in our expenses in 2010. Our base shopping centre property expenses increased by 27%, which was largely as a result of increases in electricity and assessment rates. I think our base cost, excluding those two items, increased by 6%. So you can understand the impact was quite significant. And we're certainly hoping that we will see more stability in respect of property valuations going forward, as well as what we would deem to be reasonable increases. Electricity, I think we do expect that we are going to obviously see continued increases over the next 2 years. But I think everybody's working very hard, both the landlords as well as the tenants, to cut costs and become more efficient in their usage.
The expansions, Mike, that we've seen from your side on, shopping centres so far is just one element that the results are focused on. The other is actual refurbishment moving forward, and a focus more so on organic growth for the year ahead. Is that the major thrust of what we should expect to see in terms of growth from your side heading into this next year?
Yes, Alicia, I think we do highlight the fact that our 2010 results were largely driven by the growth in rental revenue from the extensions that we had completed at both the Glen Shopping Centre in the south of Johannesburg, as well as Canal Walk in Cape Town. During the course of the year, we also refurbished Hyde Park, and the big focus at Hyde Park in 2011 and going forward is enhancing the tenant mix by bringing in some new entrant top brands into the shopping centre. But our key challenge in 2011 is to finalise the planning and commence development for the refurbishment and the extensions of the Mall of Rosebank. It's a great precinct. You've got the Gautrain that's opening this year. There's a lot of office development that's taking place, and certainly it's our objective to leverage off all of those opportunities and to take the Mall of Rosebank into a different space, bring in a lot of new retail product that's going to cater to that new commuter market, and we're very excited about it.
Francois, listed property had a pretty good year last year, good returns though, almost 30% total returns for investors. How are you seeing the listed property market for this year, and how does Hyprop stand out among that?
Stephen, as Mike referred to, the horrendous escalation of utility costs up 27%. At the ShopRite presentation a week, 10 days ago, a number of 36% year on year was mentioned. And so there are concerns in the market regarding the affordability of retail space, especially to the smaller retailers, and secondly, how the landlords will be able to pass on escalations in future. So I think these are the two main concerns. And also when analysing retail companies, retail or property stocks, you've got to have a view on what interest rates will do. And so there's also uncertainty building what the MPC will decide regarding local interest rates. So I think that's another uncertainty building which could affect the attractive or the relative attractiveness of property stocks in general. And Hyprop, it's a well-managed business Recently, they've acquired the retail portfolio of Atterbury, and I think the market will look out with anticipation how these two businesses will merge and extract the synergy as explained to the market in the announcement.
Mike, just looking at that acquisition of Atterbury, I mean, what do you see it bringing to the portfolio over the next year? Because as Francois has highlighted, focus is on how you're going to be extracting value, maximum value from that component.
Alicia, yes, the purchase of Atfund Retail is a great coup for Hyprop. I think it's a coming together of two really great property portfolios with good quality regional property stock. I think the advantages to Hyprop really there are several. The first is in respect of the fact that we take our asset base up to 20 billion, our market cap up to 15 billion, which puts us in a scale where we can potentially attract some international investment. It should potentially see a re-rating in our stock, and I think it will also, as a result of the makeup of our unit holder profile with the issue of new units, also significantly improve the liquidity in the market, which I think are all to the advantage of investors. In terms of the actual performance, anticipated performance, the acquisition is yield enhancing. We're not expecting any short-term dilution, so we will see an enhancement in distribution growth going forward as a result of the acquisition. A combination, obviously, both of the property performance as well as the increased gearing. In the medium to longer term, the Atfund Retail portfolio is a younger portfolio than Hyprop, so we're sitting with slightly more mature centres than they have, and so the opportunity for upside as a result of the acquisition is also sort of in a 5 to 10 to 15 year period, much stronger for Hyprop. The other advantage also, just in respect of the Mall of Rosebank, obviously is a challenging project. It's a fairly expensive project, and the advantage is that any dilutionary effect from that extension in the short term would be spread over a significantly larger base.
Well, Mike, I understand that you'll be stepping down as CEO tomorrow, and that Peter Prinsloo, a former CEO, will be replacing you from May. Are you able to tell us where we're going to see you re-emerging?
Well, I think I'm looking at a few options, but I've obviously got a lot of experience in dealing with both the launch and the management of big shopping centres, so that's where my focus is going to be, and in likelihood working on my own.